Imagine you're planning a trip abroad. You've saved up some money, and you need to exchange your currency for the currency of the country you're visiting. When you look at the exchange rate, you might notice that it fluctuates over time, and that the value of your currency can go up or down relative to the other currency. But have you ever wondered why this happens, and what factors influence these fluctuations? In this video, we'll explore the complex world of currency exchange rates and try to answer these questions. First, let's define what we mean by exchange rate. An exchange rate is the price at which one currency can be exchanged for another. For example, if the exchange rate between the US dollar and the euro is 1.2, it means that one US dollar can be exchanged for 1.2 euros. Exchange rates can be expressed in two ways: as a direct quote, which shows the price of the foreign currency in terms of the domestic currency, or as an indirect quote, which shows the price of the domestic currency in terms of the foreign currency. Now, let's talk about what influences the value of a currency. There are many factors that can impact exchange rates, including economic, political, and social factors. Economic factors are perhaps the most important, as they reflect the overall health of a country's economy. For example, if a country has a strong economy with high growth and low inflation, investors are more likely to invest in that country, which can increase demand for its currency and drive up its value. Political factors can also have an impact on currency values. For example, if a country is experiencing political instability, investors may be hesitant to invest in that country, which can decrease demand for its currency and drive down its value. Similarly, if a country is engaged in a trade war with another country, its currency may become less valuable as investors worry about the potential impact on trade and economic growth. Social factors can also play a role in currency values. For example, if a country is experiencing a demographic shift, such as an aging population, this can impact the overall demand for goods and services, which can in turn impact the value of the currency. In addition to these broad factors, there are also more specific factors that can impact exchange rates. For example, central bank policy can have a significant impact on currency values. If a central bank raises interest rates, this can increase demand for the currency as investors seek higher returns. Conversely, if a central bank lowers interest rates, this can decrease demand for the currency as investors seek higher returns elsewhere. Similarly, trade balances can also impact exchange rates. If a country exports more goods than it imports, this can create a trade surplus, which can increase demand for its currency. Conversely, if a country imports more goods than it exports, this can create a trade deficit, which can decrease demand for its currency. Now let's talk about how exchange rates are determined. Exchange rates are determined by the foreign exchange market, which is a decentralized market where currencies are bought and sold. This market operates 24 hours a day, 5 days a week, and is the largest financial market in the world, with an average daily turnover of over $6 trillion. The foreign exchange market is made up of a network of banks, financial institutions, and retail traders. These participants buy and sell currencies based on their expectations of future exchange rate movements. For example, if an investor expects the value of a currency to go up, they may buy that currency in the hopes of selling it later at a higher price. Similarly, if an investor expects the value of a currency to go down, they may sell that currency in the hopes of buying it back later at a lower price. In addition to these individual transactions, there are also larger transactions that can impact exchange rates. For example, governments and central banks may intervene in the foreign exchange market to buy or sell currencies in order to influence exchange rates. This is known as currency intervention, and it can have a significant impact on exchange rates. Another important factor to consider is the role of speculation in the foreign exchange market. Speculation refers to buying or selling a currency based on the expectation of future movements in exchange rates, rather than based on fundamental economic or political factors. Speculators can have a significant impact on exchange rates, as their trades can influence market sentiment and create trends that other investors may follow. So, Now that we understand the factors that influence exchange rates and how exchange rates are determined, let's talk about what happens when a currency's value changes. When a currency's value goes up, it means that it can buy more of another currency than before. This can be good news for consumers and businesses in the country whose currency has appreciated, as it means that they can buy goods and services from other countries at a lower cost. However, it can be bad news for exporters in that country, as their products may become more expensive for foreign buyers. Conversely, when a currency's value goes down, it means that it can buy less of another currency than before. This can be bad news for consumers and businesses in the country whose currency has depreciated, as it means that they will have to pay more for imported goods and services. However, it can be good news for exporters in that country, as their products may become more competitive in foreign markets. It's worth noting that exchange rate fluctuations can also impact international investment flows. For example, if a foreign investor wants to invest in a country whose currency has appreciated, they may need to pay more for their investment. Similarly, if a foreign investor wants to invest in a country whose currency has depreciated, they may be able to get a better deal. In conclusion, the value of a currency can go up or down based on a wide range of economic, political, and social factors. These factors can influence demand for a currency, which in turn can impact its value. Exchange rates are determined by the foreign exchange market, which is a decentralized market where currencies are bought and sold based on expectations of future exchange rate movements. Exchange rate fluctuations can have significant impacts on international trade and investment flows, and can create winners and losers within countries.